Welcome everyone to our Lincoln Learn today. We're going to start at 102 to allow others to come online. So at 102, we're going to start the presentation. Welcome again. Alrighty, it's 102. Hello everyone and welcome to our February's edition, of IMPLAN's Lincoln Learn. Today's topic is quantifying income earned in the gig economy. So our Lincoln Learn is a bi-monthly series that we give users a chance to take a deeper look into various concepts with the Ed Services team. Today we are going to be talking about the gig economy. The gig economy offers a flexible source of income, and it is defined by the Bureau of Labor Statistics as contingent and alternative employment arrangement, whereas electronically mandated employment is defined by the Bureau of Labor Statistics as short jobs or tasks that workers find through mobile apps that both connects them with customers and arrange payments for their tasks. This includes Uber, Lyft, DoorDash, and Instacart, among others. These jobs are often part of the gig economy. Today, we will demonstrate how you can utilize IMPLAN to quantify the economic impact in income earned in the gig economy. Okay, so first off, I would like to introduce myself. My name is Atolia Manjo, and I am a software support assistant here at IMPLAN. Joining me today is my colleague Michael Neely, who is an education support specialist here at IMPLAN, and we are both on the education services team. Today's presentation is intended to be very interactive, and we will love to discuss any questions that you may have In order for your questions, you can, in order to ask your questions, you can click on the icon on the left-hand side of your control panel to raise your hand. In conclusion of our presentation, the presenters will call upon you. Once you are called upon, please unmute your microphone and ask your questions. You may also post questions at any time during the presentation in the chat box on your screen. So without further ado, I will go ahead and hand the mic over to Michael, who will get us started.
Thank you so much for that introduction, Atolia. Again, I am Michael Neely, an education support specialist here with IMPLAN. I've been here since January of 2021, and I specialize in, working with our training and data library. But today, I want to get into a little bit of how we can quantify income earned in the gig economy. So first, before we get into anything else, I want to take a second and address what the gig economy is. Atolia touched on it a bit in our introduction, but I want to elaborate just a little bit more on that. So, in general, the gig economy is a type of labor market or subset of the labor market where contractors and freelancers are paid according to short term assignments and tasks rather than full or part time jobs. So naturally, this is going to present workers in this market with a flexible source of income. More technically speaking, the gig economy is defined by the Bureau of Labor Statistics as a contingent and alternative employment arrangement. Contingent workers are people who do not expect their jobs to last or reported that their jobs are temporary, and they do not have an implicit or explicit contract for ongoing employment with their employer. Contingent and alternative employment arrangements, according to the BLS, include but are not limited to independent contractors, on call workers, temporary help agency workers, and workers contracted by firms. However, in 2017, the Bureau of Labor Statistics began to measure an emerging line of work, which is electronically mediated employment, or EME. EME is defined by the BLS as short jobs or tasks that workers find through mobile apps that both connect them with customers and arrange payments for their tasks, like Atolia said. This would include Uber, Lyft, DoorDash, and Instacart, among others. So these jobs are often going to be a part of that gig economy. So, capturing the true size of the gig economy, as you may know, can be somewhat of a challenge. Because this work is often performed to supplement income from a primary or potentially even full time job. Uh, in the BLS's Contingent Worker Supplement Survey, or the CWS survey, um, questions on contingent work and alternative employment arrangements are only going to be asked about a person's main job. So, therefore, no one single implant industry is going to uniquely define gig economy work. Instead, what we actually see is that this is a form of employment that exists in multiple different industries, particularly where temporary or freelance work is common. Again, getting into some more examples. For example, Instacart shoppers would fall into industry 520, other personal services, and Uber drivers would be classified with other taxi services in industry 418, transit and ground transportation services. But it's important to keep in mind that although these jobs do exist in such industries, the workers are not going to be broken out separately. That is, employment counts in these industry also are going to include workers who are not part of the gig economy and all full and part-time employment. So that would beg the question: what is the best way to quantify the economic impact of gig economy workers? Well, because it's not feasible to separate the workers in these industries by type of employment, uh, it's probably best to quantify the economic impact of income earned by these gig economy workers, which, of course, if you're familiar with it, in IMPLAN, we can do this with a household income event. A little bit more on those. Household income events are appropriate to model a change in household income that is isolated from industry production and payroll. So household income events would be perfect in a scenario when we don't really have a good idea of which industry is going to be paying these workers. More generally speaking, household income represents the income received by people for their participation in production, from government and business transfer payments, and from returns on capital, such as interest payments or dividends. In IMPLAN, household income events allow the analyst to pick which income groups will receive the gain or loss of income. And the last note is that household income events only affect household spending, so therefore, we will only see induced effects in our results, and that would mean that there are no direct or indirect effects. So now that we have gone through a quick overview of the gig economy, as well as how an implant user could potentially estimate the economic impact of the gig economy itself, I want to go ahead and get into an example of how to set up such an analysis and implant. So naturally, like we briefly touched on at the beginning, in the gig economy, the majority of workers are going to be utilizing their position as a means of supplementing their main source of income. In that case of a worker supplementing their full-time position, it is also safe to assume that this worker would not be in the lowest household income bracket. Um, and the reason you can assume that is because not only are these people working full-time in one position or maybe part-time in one position, but they're also spending some of their quote-unquote free time picking up extra hours via electronically mediated employment. So, for our crude example today, I want to think about our friend Hubert. So, Hubert is single and he lives in Charlotte, North Carolina, which of course is in Mecklenburg County. And Hubert works as the manager of a local retail store on the weekdays, Monday through Friday, from 9 a.m. to 5 p.m. And his job as the retail store manager makes him an annual salary of just over $50,000. And in plan, this would drop Hubert into that $50,000 to $70,000 a year household income group. However, to supplement his salary income, we're going to assume that Hubert began to spend his free time working nights and weekends as an Uber slash Lyft driver. So his Hubert's role in the gig economy is going to earn him an additional $10,000 a year. Although this, again, simple example does not take into the fact that Hubert is giving up significant amounts of his personal free time. So that opportunity cost of his time spent on this, it's reasonable just to say that the net effect is still positive, and obviously the net effect will be positive on his yearly income. And let's say, for instance, that we also know that Hubert's situation isn't unique. For exemplification purposes, we'll say that we know that 1,000 people in the city of Charlotte have been forced to make similar decisions to supplement their lifestyle. A quick calculation would tell you that this leads to an additional $10 million in labor income for households that earn $50,000 to $70,000 a year in Mecklenburg County. Of course, to quantify the economic impact of this new $10 million in household income, we can use a household income event in IMPLAN. Another note about household income events that we're going to want to make sure that the payroll taxes and any income from incommuters has already been deducted, and we will assume that they have. Um, and also remember that IMPLAN, after running this event, is going to further deduct for personal taxes as well as savings. So with that, go ahead and jump into IMPLAN here. Starting from our home screen, we will navigate to the region screen where we can select our region, of course. We could either click on the map view to get to Mecklenburg County, or we could utilize search bar, which is what we'll do. Search for Mecklenburg County, North Carolina. Once it's populated on the right, we can go ahead and create our project, which we will name something like Link and Learn February, and then save it. Saving our project will navigate us to our impact screen where we can start getting some events thrown into our Mecklenburg County group. So our first event that we will name Supplemental to represent the type of income this is for Hubert will be an household income event with the specification being this 10,005 or households $50,000 to $70,000. And then our event value, of course, is that $10 million of additional income earned by this household income group. Now, all we have to do is grab this handle here and drag it to our Mecklenburg County group, and we're all good to go. Remember that we're going to be using the 2019 data year, and we want to see these results in 2022 dollars or current dollars. Although the majority of gig workers are going to be supplementing their main source of income, obviously that wouldn't be the case for all workers that are in the gig economy. So we could take, for example, Alexis. Alexis is a full-time student at IMPLAN University, or IU, which is located in Mecklenburg County as well. Like a lot of students, we assume that Alexis spends most weekends either participating in philanthropy or attending university-sanctioned events such as theater arts or sporting events. So, to help her pay for books as well as tuition, Alexis has picked up a part-time role as an Uber/Lyft driver, where she logs hours after class during the week. So this role in the gig economy is going to gain Alexis roughly $10,000 annually, and university or IMPLAN University experts believe that there could be as many as 1,000 IU students who participate in the gig economy in a similar capacity. So to quantify the impact of Alexis and her fellow students' part-time gig income, we'll again use a household income event. In Mecklenburg County in the 2019 data, and we'll look at those results in 2022 dollars for an apples to apples comparison across our different income groups. Of course, like you may have just deduced from what I just said, there are going to be a couple of differences in how we set up this event and run the analysis. First, we are going to choose the event specification of households less than $15,000 because this is Alexis's main source of income, and she will be earning less than 15,000, 10,000 to be exact. And for the event value, we're going to also only use $10,000 in income that she earns from her part-time role, and I'll show you why it'll be 10,000 instead of 10 million in just a second. So going back to IMPLAN, where now we will start from the impact screen, we're gonna hit our option at the top left to add a new event. We will name this event primary. It will also be a household income event, and our income group is going to be those who earn less than 15,000 annually. And for our event value, we just want it to be the $10,000 that Alexis herself earned. But remember, there could be as many as 1,000 different students, just like Alexis at IMPLAN University, that we'd like to analyze. So we can just go ahead and grab this and drop it in our group. We see at the top of our Mecklenburg County group, we now have two events, our supplemental and primary income. So now I want to go ahead and take a second to highlight one of the cooler features in IMPLAN, I think, which is scaling. We could either scale our entire group or individual events within the group. So scaling means just multiply your event value to scale it to a larger value. If we toggle the event scaling from our group options right here, our little abacus icon, we'll hit that and then toggle event scaling. You see now we can input a scaling factor for each of our events. If we wanted to quantify the economic impact of, let's say, 50,000 students, we could just put 50,000 there. But for our example, we just want to see 1,000 students who earn that additional $10,000 in income. So we'll scale our event by 1,000. Now we should be all good to press run. So we'll go ahead and do that. Note here that the results in this case would be exactly the same if we had just multiplied that 10,000 by 1,000, or our scaling factor, and manually used that for the event value, just like we had done in Hubert's example. So just a quick note there. So while that is running an IMPLAN, I've of course already pulled the results by event in 2022 dollars, so we can take a moment to examine those. So the total economic indicator results, which remember are going to be equivalent to the induced economic indicators, would look like this if we put them in 2022 dollars. You see we have two different rows, one for Hubert or supplemental income and one for Alexis or our primary income. As you can likely see from this, across the board, the primary income row has supported more employment, more labor income, more value added, and of course, about $1.3 million more of output when compared to Hubert's example or the supplemental row. If we looked at the tax results that you'd find on that overview page, you would see the same exact thing. Across the board, workers who use their gig economy role as their primary source of income support higher induced taxes. So in total, roughly $135,000 more for that same $10 million in household income. So in our two similar but distinctly different examples, we quantified the effect of $10 million of new gig economy income earned through two different household income categories. Again, those were households that earn less than 15,000 and households that earn between 50 and 70,000. The reason we did this, again, was to analyze the difference in resulting effect from people who use their gig economy employment as a primary source of income versus those who may only use the gig economy roles to supplement their main source of income. The results were pretty clear in that they consistently suggest that those who use those use the gig economy employment as their primary source of income are going to generate a larger economic effect for each indicator as well as in our tax results. So now that begs the question, why is that the case? So the simplest answer to that would be for two reasons. Again, taxes and savings. But more generally, the big takeaway is going to be that these two income groups are going to spend their income in differing ways. So a little bit more on that. Typically, those that earn higher incomes are more likely to save a percentage of their income than those that are in a lower income bracket. Additionally, that are in lower income groups would also pay a smaller percentage of their income to taxes, if any at all, especially when compared to higher income groups. Both of those two factors we can confirm in IMPLAN via the social accounting matrix or SAM that is available in the region details. In the quote unquote aggregate I by C social accounting matrix, which again is in the region details, you can see household columns. So those household income groups as columns. You can see their payments to a row that's named capital. That payment is going to include net savings. Similarly, the household income columns groups payment to federal government non-defense row and state and local government other services row would reflect some of those state and federal taxes paid by that household income group. So we can go ahead and take a look at this in IMPLAN for Mecklenburg County. Coming back here to IMPLAN, we will go from our impacts page back to our regions page. And we can hit our little squid icon on the far right to hop into the region details for Mecklenburg County. So from here, we'll just need to head to social accounts, down to I by C social accounting matrix, and then we'll go to the aggregate I by C SAM. So from this I by C aggregate SAM table, we can look at the household income groups as columns if we scroll to the right. right here, starting with households less than 15,000. And if we come down to row 24, we can see capital, which again, this is going to represent that household income group's payment to the capital. The figure that we find at the intersection of household income and capital would include net savings. So for this first column, households less than 15,000, we can see that this value is actually missing, which again, this is going to be because they are not necessarily net savers. People in this income are likely to spend all of their cash on the typical necessities and may actually spend more than their income via credit lines. In contrast, if we go a couple columns over to the households earning between $50,000 and $70,000 in income, we see that there is in fact a value here. So that would mean that there are some net savings of about, if you did the math, about 2.7% in fact. So in this I by C aggregate SAM, we can also get a better idea of how each of these household income groups pay taxes on their household income. So if we look at, again, back to our less than 15,000 column, that payment to the federal government non-defense row right here would so that federal government non-defense row and the state and local government other services row would generally reflect some state and federal taxes paid by this group. And you can see that the less than 15K households have a negative value up here for federal government non-defense. And the households that earn between 50 and 70,000 is actually paying roughly 4% of their column total to that particular entity. And there would also be a similar discrepancy in the state and local taxes as well. So if you come down here, you see about $1.4 million out of 1.5 billion versus $200 million on 6.2 billion. So similar discrepancies. Again, the main takeaway from this is that it's going to help explain some of the notable differences we saw in our impact results of our two different subsets of gig economy workers. Because in general, they just spend money differently. It's not going to be the same given the same amount of money. In fact, if we jump into our output results for our supplemental event, again, we're in our results and we filtered for our supplemental event, we can further reinforce the idea that these two different groups spend money differently if we just take a quick look at the industries by impact table. While you will see a good bit of similarities in which industries are impacted most, there are some differences. For example, if we come down to industry 442 in this industries by impact table, other financial investment activities, you can see this is the 16th most impacted industry for that higher income group. But if we go to the same table for that primary income group of gig economy workers, that industry is only going to be 28th most impacted. So some subtle differences, but differences nonetheless. Anyhow, we can conclude that at least for Mecklenburg County, that lower income households are going to generate a larger economic effect when given the same additional income. So this, of course, would include but not be limited to income that is earned in the gig economy. So with that, I will go ahead and pass the mic back off to Etolia so she can get us finished off and we can jump into some questions.
All righty. Thank you, Michael, for that information. Um, hope that was beneficial to everyone. We thank you for joining us today. Just want to quickly mention For those that may not have may have missed the earlier presentation from the beginning, if and when you have a question, we ask that you click on the hand icon on the left-hand side of your control panel to raise your hand. At the conclusion of the presentation, our presenters will call upon you. Once you are called upon, please unmute your microphone and ask your question. Or feel free to post questions in the chat box on your screen. Rounding out this session for our IMPLAN Link and Learn, we just want to stress the fact that we plan on having these presentations once every other month, and we want to make sure that in the future sessions we cover topics that are pertinent to our users. We welcome all recommendations, and if you have any ideas, please feel free to email us at support@implant.com. Our support at implant.com, the website is 24/7 support resource. You can find recordings from past Link and Learn sessions, as well as registrations for upcoming sessions. Now, with the time we have left, we would like to open the floor for questions. Again, remember to click on the hand icon on the left-hand side of your control panel to raise your hand, and we will call upon you. Once you're called upon, please unmute your microphone and ask your questions. The floor is open. Thank you, everyone.
Okay, so it seems that we did have a few questions that rolled through as we were presenting. So the first of those would be, how can temporary income be calculated and what is its impact on wealth creation? So income, whether temporary or throughout the year, is handled the same way in IMPLAN. So it's not going to matter if a person works in the gig economy just over the summer or holiday season or throughout the entire year. Because IMPLAN is an annual linear model, there is no assumption made or impact shown on how these gig jobs can impact wealth creation. If you want to assume that gig work is increasing incomes consistently, you could consider analyzing multiple years to show that uptick in income. It's a great question. So we had another question come in that is, are we to make the assumption that the income variable is gross, not AGI or net income of expenses? So yes, that input value is going to represent gross income. If your input value was adjusted to remove expenses, then you could model those expenses in separate events. Another good question. So another question came in. Is it similar to the temporary income that Friedman referred to, and what is the consumption function? So I got a little help from Dr. Klaus on this one. So she says that the temporary income versus permanent income hypothesis says that the temporary increases in income will be saved more than permanent income. IMPLAN isn't going to assume any differences in spending between gig workers and more traditional jobs. Assuming you want to show higher savings rates, which again could go back to Friedman's work, this can be modeled in IMPLAN. It's just a tad bit more complicated, but completely doable. So let me get this box back open. So another question was, how do you reflect the fact that Uber driving creates demand for gasoline, etc.? So again, this was kind of covered in the last question, but to reiterate, if your input value for gig earnings is adjusted to remove expenses, you can model those expenses separately as commodity or industry events. So one more question was, how does IMPLAN account for the accounting matrix internally? As gig work is not going to be reported as W-2 income and rather 1099 income, would this suggest higher taxes paid than actual? So if they're 1099 workers, then they are what we define as proprietors. The tax differences are that first, proprietors pay both of social insurance taxes. In contrast, employers pay part of wage and salary employees' social insurance tax bill. Secondly, proprietor data are on place of residence, so they pay those social insurance taxes where they live, whereas wage and salary social insurance taxes are paid by place of work instead of residency, which may or may not be in the same place they live. Okay, so now I think we've got a couple of hands up that I would like to address those. Also note, if we do not get an answer to your question live, that we will reach back out to you personally after the presentation to get any and all questions answered. So let's see here. We have our attendees box. So it looks like Susan, you have your hand raised. If you'd like to unmute yourself, I will allow you to unmute yourself now and ask your question.
Hi, yeah. So I'm looking at this, and you said that it's just the difference in the taxes with the employer payment for UI and for Social Security taxes, which self-employed wouldn't pay UI anyway, unless they choose to pay into that system. I guess the other question I have is, because the way 1099 income is introduced into the accounting system, it would be available to the individuals running Uber, Lyft, and all that to be able to take advantage of tax deductions that are typically reserved for traditional business income pass through. So I guess the back end matrix I'm asking about in IMPLAN is when it comes through, it looks like this is, I guess the way you put it in was gross income. So would that matrix follow through like a similar W-2 reported income, or would that follow through with recognizing this as more like a gift per se? Because I wonder if those taxes on the individual side, not necessarily the induced effects, so like the spending and the economy's taxes, but more just the individual who earns that extra income, would those be technically overstated slightly, because you can have a negative effect as a result of the 1099 income coming through? Thanks.
Of course, great question. For that one, Candy, would you like to unmute yourself and go a little bit more into detail on that?
Yeah, so I think I'm understanding, but I might have missed a little bit of nuance in your question. The focus being that we're looking at the difference between somebody who's working on W-2 income versus a 1099 income. So the big difference in how that's treated in IMPLAN is 1099 workers are going to show up as those proprietors. So they're going to be their own little small business owner. And the difference on that is that the way they're taxed, obviously, and that proprietors are always going to be assumed to be living within region. So there's no commuting that's going to be associated with proprietors within IMPLAN. Now, what is going to happen is that when we look at the income, whatever income group they show up in, they're going to spend their money just because they're a different kind of employee legally and according to taxation. They're going to spend their money in the same way as someone who has a traditional W-2 type job, like, you know, Michael and I do here at IMPLAN. So just because, you know, our friend Hubert has this job where he is working in the gig economy, he's still going to go to the grocery store and spend his money pretty much the same way I am with my job here at IMPLAN. I'm not sure that I got everything that you wanted in your question, Susan. So if there is more, please do jump back on it and let me know.
Yeah, I apologize, Candy. So I guess I wanted to know, and I'm going to try and make this very concise. So when you put that 70, that extra 10, was it 20, 10? I can't remember what it was for the primary earner who made $50,000. So when IMPLAN sees that, does it look at that as being the, okay, so here's 50 plus 10, so really it's 60,000. If the individual took a standard deduction, which could be $24,000, or depending on if they're married, single, whatever, would we see that kind of flow through as just a normal 1040 kind of form, or would there be some potential implication inside of it that says, oh, well, so many people in this bracket have sole proprietorships, or if you see an income change in the household variable like that, it typically would cause, it triggers internally something to say that that's a sole proprietorship.
Okay, so we actually have our chief economist, Dr. Jenny Thorvaldsen, on the line, who I have just unmuted. Jenny, if you want to hop on and add a little bit of clarity to that, go ahead.
Hi, sure. Can you guys hear me okay?
Sure can.
Excellent. I just wanted to point out, this might help. There in IMPLAN, if you used the event type that is a labor income change, in that event type, that's where you can specify whether it's employee compensation, which is the fully loaded wages of wage and salary workers, so employees, or you can specify that it's proprietor income. And that's where the tax impacts will be treated differently, because you're telling the software, hey, I know this is a 1099 person versus I know this is a W-2 person. But when you go choose the event type or activity type that is one step past that, where it's just saying, I'm looking at this spending, then you're already taking out the tax part, and you're just saying, this is the take-home wages, and this is what that person is coming home with after taxes. And at that point, it doesn't matter, kind of to what Candy was saying, it doesn't matter what type of employee they are or contractor at that point, because you're looking at it from the post-tax part place, I guess. And so you're just looking at the spending of what they're bringing home with them. So
Okay,
it kind of just depends on how you analyze it.
Okay, I apologize. Just real quick. So, like in that example that was run, if you were trying to get to a more probably within reason taxable income adjustment, so because this is going to be a big thing next year with tax year 22. If we were looking to get a sense of that impact, you would really want to probably think about what those level of expenses might be they reduce their Schedule C by to get the remaining business income that would flow through to their 1040 before the AGI is calculated, correct?
Yeah.
And use that net reduction in income and then multiply it to change the household income factor for spending effects.
I believe so. That sounds right to me.
I mean, I just wanted to verify. Thank you so much. Because yeah, this is going to be a big deal, I assume, next year when a lot of states, because there's only 10 states that have that threshold right now. The federal threshold changes for this tax year. Next year, I feel like this will be a much bigger topic. So that's why I was asking. Thank you.
Great question.
Thank you for hopping on and giving us some more detail on that question, Candy, as well as Jenny. So we had another question come in that kind of got touched on in that answer, and that is, what instances, if any, would you model a labor income change rather than a household income change for gig workers? So if the event value you had did include some of those benefits, so it hadn't been reduced from your event value, as well as the incommuting, that could be one instance where you would prefer to use a labor income change rather than a household income. And also another instance could potentially be if you did not have an idea what household income group would be receiving that income. So labor income allows you to be a little bit more generalized. Now, let's see. Another question that came through is, do you always have to make an assumption regarding how many Ubers are working in the county? So not necessarily sure what you're asking there. We did make an assumption in this particular example about how many workers there would be, but if you only had the event value instead of, a number of workers with a single event value, that would work just as easily. Somebody else asked, do you mean the in-commuters were not included in this case? And yes, that is correct. We did assume that from our event value that in-commuters had been deducted. So another question came, and that is, the examples of gig workers you presented are all single-person household, correct? If they live in multi-person households, you need to add their fellow household members' income before deciding which income category to put them in. And that is 100% correct. We assumed that for Hubert, both Hubert and Alexis, that they were the only income earners for their particular households. So if there were more than one income earner in their households, you would need to include their income earned in deciding which income group they would be a part of. All right, just scrolling through this list here. So another question came rolling through, and that is low income, I'm assuming income groups pay more as a proportion of their income for indirect taxes. Are they included in taxes paid to state or the local economy? So,
I can jump in on this one, Michael, if that's helpful.
thank you, Candy. Of course.
Absolutely. Yeah, so we do see that low income people having disproportionate rates of payments for things relative to other earners in terms of level. But what we also see is that our lowest income earner categories often have negative taxes because they're receiving subsidies from the government in terms of childcare assistance, food nutritional benefits, and things like that. So it's really common to see at those lowest earning levels, excuse me, that they will have negative tax rates on those things. And again, as Michael showed you, you can dig into all of that data, what it looks like for your region as well, by popping into that region details section and see what those differing rates are across the income groups.
Thank you so much, Candy. All right. Well, if nobody has any other questions, it has been a few minutes since another one rolled in. I would like to just take this chance to thank everybody again for joining us in this presentation. And we look forward to hearing from you on ideas for future presentations and joining us for the next edition of Lincoln Learn. Thank you, everyone.